If we look at bond yields thus far in 2022, we've seen bond yields rise across the whole curve due to the expectations of higher inflation, higher interest rates. And really, the speed of that increase in yields has been unprecedented over the first half of this year. What is likely to happen in the second half, though? Well, at the moment, there's a lot of negativity around, certainly in terms of inflation, the persistence of inflation, interest rates needing to rise further around the world. We agree with that, but that's why yields have risen as far as they have done already across the curve. So as we go into the second half and people start to look more at the potential slowdown in economies, that's when we reckon that actually bond yields are not going to rise further from where we are right now. So we saw them reach in the US 10 years around about 3.5%. We would expect 10-year yields in the US to be 3% and below as we go through the second half of this year. So those big increases we saw in the first half of this year, we won't see those increases repeated as we go through the second half. If we look at equity markets, profitability across equities in aggregate has been incredibly resilient. As we start to see slowdown in economies across the world, and yes, we have those pressures from supply chains as well, commodity prices being high, some pressure on the consumer as well, partly because of disposable income going down with high oil prices and food prices also, we'd expect to see increasing pressure on the profitability of companies. So that's what we'd expect in the second half of this year, profit expectations to come down. However, on the other hand, we also look at the discount rate. And the discount rate, where we've seen expectations rise during the first half of this year, as we go through the second half, we think that's quite possible that the expectations around discount rates will have peaked. And so consequently, the other side of the equation is no longer seeing those interest rates rising. So some pressure on profitability, but actually the discount rate no longer rising. And in fact, maybe a bit lower than people have feared at certain stages of the first half of this year. So in terms of the outlook for equities, we have to be a bit careful because we are seeing changes in consumers' attitudes, in where there is spending, and we need to identify where that may be resilient, where that may be coming under pressure. But in aggregate, given the falls we've already seen in equities thus far this year, we'd be more constructive around equities as we go into the second half of 22. For commodities, we'd seen commodity prices rise ahead of Russia's invasion of Ukraine, but then we saw the oil price in particular, food prices also rise further after the invasion. And we've seen the oil price, for instance, during the second quarter of 22, trading somewhere between $90 and $125 or so a barrel. I think as we move forward, as we see investors start to look at potential demand destruction from a slowdown in economies, that actually the oil price is not necessarily going to rise meaningfully from where it is at the moment. The one thing I would say here, though, is that there is risk around this scenario. Because if we look, for instance, at the winter months, and we look at Russia maybe stopping supply of oil or of natural gas, that could lead to another leap in commodity prices. So central case is that we see less pressure on rising prices in the second half of this year, but there is that risk out there that the uncertainty could bring about higher prices at some stage. Well, if you look at real assets, I mean, real estate would be the obvious real asset, where prices have remained elevated, and real estate has significantly outperformed bonds, significantly outperformed equities. But in a rising rate environment, would we expect the property to be resilient? Maybe resilient, but not to the degree that it has been over the first half of this year. And so we would see potential for the property market to no longer be rising, to come off a little bit in the second half of this year, particularly given the cost of debt is rising. And they're certainly susceptible to the cost of debt in terms of real estate prices. So we would look at that and say, yes, they've outperformed, but we'd be wary about suggesting that real estate will continue to outperform as we go through the second half of 22.